All right, our next presenters is Canacol. They're a leading independent gas exploration and production company in Colombia with a goal of creating prosperity and satisfaction for all their stakeholders. Reliable and sustainable producer of energy in Latin America. With us today for the presentation is Mark Tier, Senior Vice President of Exploration. Mark has 35 years of experience with a number of international Canadian energy companies in Brazil, Ecuador, Colombia, Argentina, Australia, and Canada. Great to see you today, Mark. Thank you for joining us, and I'll turn the floor over to you for your presentation.
Well, thank you again. Thank you for the opportunity to present to you all this afternoon. I'm Mark Tier, Senior Vice President of Exploration for Canacol, and so this is an update on our company's activities in Colombia. If we'd advance to the next slide, please. Next slide, please. Okay, so we're a publicly traded company, primarily trading on the TSX in Canada. We also have a listing on the Colombian exchange in Bogota, and a listing on the OTC in the United States. Our current market cap is 487 million US. Our share price in Canadian dollars is $3.59. Net debt position here is 322 million. Enterprise value of 809. We've recently, for those of you that might be familiar with our story and followed our Q2, we've recently reaffirmed our quarterly dividend at 5.2 cents per quarter, which at our current share price is about 5.8% dividend yield. On the right-hand side, you'll see a map of the country, of course, of Colombia, and our land position. Most significantly, you'll see that the larger blocks we have are situated just south of the Caribbean coast, and Cartagena in particular. Given that we are almost exclusively a gas producer, in fact, we are now the largest independent producer of gas in Colombia. Our markets are all along the Caribbean coast, some 150 to 200 kilometers north of our asset base, and our main plant at Hobo, situated on our land position as you see it. Our reserve base at present is about 625 BCF of 2P reserves, and as of December 31st, 2019, valued at about $1.5 billion US. Based on our current production, we have an RLI of about 9 years. We have a pretty remarkable FD&A there of 67 cents. For those of you that are comparing our company and its asset quality, if you will, with perhaps our North American peers, that FD&A is in fact quite remarkable. We're drilling into conventional reservoirs with excellent porosity and permeability, such that for $4 million, we can drill a vertical well and immediately tie it in. And that well could produce anywhere from 5 to 35 BCF of gas. That'll be the cum production for a particular well we might drill. We have about 25 producers right now, producing wells, that is, producing over 200 million cubic feet of gas per day. So the capex involved in realizing that type of production and cum production per well is in fact very low, as that finding and development costs would reflect. We've recently had Gaffney Klein prepare a resource estimate, a prospective resource estimate of the remaining prospectivity across our acreage base, and they estimate we have about 4.7 TCF of unrisked resource potential across our acreage possession. So From my point of view as Senior VP of Exploration, that validates the running room we have across our acreage position. Not only have we established a significant and material 2P reserve base, but we have significant running room across our acreage position. Next slide, please. So why, you might ask, Colombia? Right. So, and in particular, natural gas. Colombia is it's a developing economy with an emergent middle class. And over the last 30 years, I would say over the last 15 or 20 in particular, it has really risen to a standard of living that it's been able to provide, as I say, an emerging middle class, such that its economy, of course, growing in lockstep with the demands of that emergent middle class. And with that, coincidentally, is a demand for natural gas, simply as a fuel source for power. And that is the opportunity that Canacol has stepped into over the last 6 or 7 years, and finds itself right now as the largest independent gas producer in the country. Next slide, please. Okay, so right here is an interesting plot insofar that while Canacol has established itself as the largest independent gas producer in country, the national oil company, which of course has the lion's share of the reserve base in country, sees its reserves in decline. And that is simply because the national oil company has been more focused on the oil opportunity in the country, as has other operators. Canacol has kind of taken that fork in the road and decided to establish itself in the gas world, if you will, in country. And while others have continued, including the national company, continued to pursue the oil story. And as a consequence of that, since 2012, you'll see a gradual decline of the reserve base as a whole in country. In the meantime, Canacol has positioned itself based on the plot that you see there, as an emergent and important gas producer in country. Next slide, please. Okay, and here's the story right here. Simply, based on the not only declining reserves, but also the output for production in the country, you see by the blue line on this plot that the supply is projected to be in continual decline, while demand, of course, being this emergent middle class society that is evolving in Colombia, the demand for natural gas, of course, is increasing. And Canacol is positioning itself to take advantage of that. Next slide, please. Okay, so in addition to the supply and demand dynamic in the country, Colombia is a signatory to the Paris Accord and recognizes its responsibility to align itself along with the rest of the global community in terms of achieving certain targets by over the next 20 or 30 years. And part of that formula that the country sees is a growing requirement for natural gas to be, if you will, the transition fuel toward renewables. And if you look at the plot, you'll see the yellow, which represents the percentage contribution of natural gas toward power, the power generation, increase over the next 20 to 30 years as it displaces other, if you will, dirtier fuel sources for power generation. Next slide, please. Yeah, of course, what is ever present in our mind right now is how collectively the E&P business is managing COVID. and we too at Canacol in Colombia are also managing that challenge. Much to the country's credit, it was one of the first countries to basically lock down as being the straightforward measure toward containing coronavirus, which it effectively has done. Having said that, of course, it's not that it's not an issue in Colombia, and it continues to administer to COVID in ways that are effective, and yet obviously has an impact on the country's economy. Having said that, while the country was in collective lockdown until early summer, it has since begun to emerge while managing COVID. And since that moment where back in April or so, or early May, where the economy started to rekindle, Canacol was able to set about initiating its operations again after that relatively brief period of lockdown, of shutdown. And I'm glad to report that we are at this time able to go about our operations in the field, albeit in a way that is limited. Our drilling rigs are moving, and we are actually able to drill, and workover rigs are moving. And the good news, though, is during the lockdown, of course, gas production or our business was considered an essential service. So we were able to basically maintain our production while being during lockdown, albeit our sales being somewhat impacted, of course, by the lockdown as a reflection of lower demand. On the right-hand side, what you see there are the sort of compensations or adjustments we've had to make in response to COVID. Initially, our guidance for this year in terms of production and sales was about 205 million. And since May, we issued a revised guidance that our sales would be between 170 and 197 million. At this point, for those of you that are perhaps not just beginning to follow our story, 170 million basically is the volume of gas that we sell into take-or-pay contracts, into fixed price long-term contracts. So our off-takers, I mean, we're 6 months into this now, this COVID situation, our off-takers have honored the word on those contracts and continue to take at least 170 million cubic feet of gas a day. The upper range, 197, basically reflects what we anticipate could happen on an annualized basis if the 20% of our total production that we sell into the spot market recovers. That is to say that in the spot market, because of the softening in demand, we have seen a drop-off in sales. Good news is that those sales in the spot market are largely contingent on the requirement for thermoelectric power generating utilities to take gas as a fuel source to generate power at a time when hydroelectric is having difficulty maintaining its base load because of seasonal constraints. And we're just about to move into the summer season, or the warm, hot season, where between this time of year and November is typically very dry, and there's typically a increase in the demand for natural gas for thermoelectric power generating utilities to backfill on hydroelectric that is unable to maintain its base load during that. So our outlook is looking looking robust, I would have to say, for the remainder of the year, such that we should come in at the upper end of our production guidance. Next slide, please. Okay, so back not only our 2020 revised plan, back in May when we issued a revised guidance, of course, we trimmed our budget. It seemed like the prudent thing to do at the time, from 114 million to 108. And the well count that we anticipated to drill this year, which originally was 12 wells, simply 2 development wells and 10 appraisal and exploration wells, has been curbed to 9 wells, of which we will drill 3 development, and the remainder will be exploration wells. The allocation of capital that you see on the right-hand side is more or less evenly distributed between exploration, facilities, development, drilling, and maintenance. Yeah, next slide, please. Okay, so this is a record, this display is a record of how we have basically achieved incremental growth in our rate of sales. What's interesting in this plot too is it also shows since 2013, it reminds us that once upon a time, Canacol was in fact an oil producer. But you can see that since 2014, coincident with the collapse in oil price and the subsequent uncertainty of oil price, the Canacol has focused its capital programs on its gas business. And what really drives the strategy here is the fact that our gas business is based on long-term fixed price contracts, where that fixed price across a number of offtake agreements is $4.75 net of transportation. And shortly we'll see a netback slide which demonstrates that, you know, net of royalties and operating expense, we with confidence by virtue of these take or pay contracts realize, you know, $3 to $4 an MCF in netback, and that's what drives our free cash flow. Okay, next slide, please. Okay, busy slide here. So on the left-hand side, we got basically the build out of our 2P reserve base since 2013. Simply, you know, we've had a great run on the exploration front. I think a little later I'll be showing you a slide on what is working for us, but simply, you know, we're enjoying an 80% success rate on our exploration program, you know, by the application of a seismic attribute methodology that is really working for us. Basically, an attribute on 3D seismic that is really mitigating the risk around identifying the presence of gas charged sandstones. And that's what's driving that plot on the left-hand side. Like we are, yeah, we're doing well in that respect. On the right-hand side, of course, you know, you've got our NPV, which is really an aggregate of the cash flows that our auditor generates, and hence the $1.6 billion of US dollars in terms of our 2P NAV. On the left-hand side, down at the bottom there, the F&D, I've mentioned that. As I say, that's a metric that is a measure of the pure capital efficiency of our program. Conventional reservoirs, 25% porosity, 5 darcies of perm. Like these wells chuck out significant production, can cum up to 35, you know, BCF, yeah, it costs you $5 million to drill and tie in. Those, of course, are our best wells. You know, not all wells are like that, but you know, it's a measure of just the relationship between capital efficiency and the quality of the conventional reservoirs that we're drilling for. And given our high netbacks, a slide which we'll get to shortly, you know, with great F&Ds, of course, that drives really excellent 2P recycle ratios that you see down here on the bottom right-hand side of the slide. Next slide, please. Okay, so gas pricing. You know, I've mentioned what I realized gas prices, as you can see the yellow line there, it's round about $5. Lately, it's $4, a little bit, $4.75. We say average $4.75. A little bit of softening most recently because the pricing in the spot market has been soft. But by the little bar chart here down on the bottom right-hand corner, comparison of our realized pricing around compared to other benchmarks showing it's a the virtue of a fixed price contract, very limited volatility around that number compared to other familiar benchmarks. Next slide. Yeah, so those of you who are familiar with the Colombia story and natural gas, of course, will also know that the country imports LNG. And so the question there is often, to what extent might LNG threaten our business model? In fact, there is a regasification plant in Cartagena, which, as you recall, is the center primarily of that Cartagena and Barranquilla of our main markets. There's a lot of information on this slide, and I'll leave it to you to study as you see fit. But the main point of it is that typically, notwithstanding that LNG prices right now on boats that are floating around the world is soft, typically the landed price for LNG in Cartagena is between $7 and $8 an MCF. So if you compare that with our realized price of $4.75 net of transportation, so sure, add $1.50 transportation that the off-taker pays for, the price of $6 to $6.50 compares very favorably with the landed price of LNG. So the point being here that LNG, we do not consider, imported LNG here, we do not consider to be any kind of threat to our business model. Next slide, please. Yeah, so looking out, we've got a couple of projects in mind of interest. Let's start with number one. So this is the power plant initiative that we've kickstarted with a joint venture partner who is Celsia. They are a thermoelectric power generating utility. They are, in fact, an off-taker of at least, I would say, one or two of our existing contracts, is eager to build a power plant within 7 kilometers of our plant. So check out where the acreage position is and where Hobo, our plant, that's J-O-B-O, if you look at the map, you'll see right there, El Tesorito plant. That is the proposed location for a new build that Celsia will build. Canacol has the option to participate up to 10%. Within 7 kilometers of our Hobo facility. And that will take another 30 million cubic feet of gas a day once the plant is built and commissioned. So toward the end of 2021, early 2022. The next big project, which is certainly the most material for our go-forward projects at Canacol, is an initiative to build a new pipeline from Hobo south to Medellin. So check out the map again. That is I'm not sure if you're seeing my mouse here, but the arrow is showing where that pipeline is going. That is the projected route for a pipeline that'll be 285 kilometers. It'll have a capacity of 200 million cubic feet of gas a day, and that Canacol is in the midst right now. As a matter of fact, it's completed the negotiation of a sales contract with the largest utility in the country, EPM, which is the utility at Medellin, to take 100 million cubic feet of gas per day. In terms of financing for the project, Canacol is taking the lead on that. It's $400 million, of which will be part debt, part equity. On the equity part, Canacol has the option to participate up to 25%. On the debt side, We're making great progress on two banks that will take the lead on the debt side. And on the equity side, the remainder of the equity share will is of interest to a number of PE companies eager to participate. So what we are waiting on right now is basically a signing of the sales agreement, which is pending for the financing then to fall in place. And subsequent to that, of course, will be the issuance of an EPC to a number of familiar midstreamers who are bidding to build on, rather to bid on this project, both domestic and international. So that project is indeed in play right now. Okay, next slide. Okay, so now we're getting a little bit more into my world. Again, this is just a zoom in on our acreage position, 1.4 million net acres. We operate basically 100%, well, we do operate 100% of our production. There's one block, all blocks that we operate 100% with the exception of one block where we have a 50% partner, and that's a remote exploration block. The acreage, I mean, basically what we've done is we've demonstrated to ourselves familiarity with the play types that are working for us that support this remarkable exploration success rate over the last 7 years. There's the data right there under track record, 80% for exploration appraisal wells, 100% of course on development wells. But these are play types that we're able to extend across our acreage position with confidence and have recently been validated by an independent evaluator. And that accounts for the 4.7 TCF of unrisked resource potential that we have there. Next slide. Yeah, so I promised you a technical map, and here it is. What is working for us? So on the left-hand side is just a cube of our 3D data. So the point being there, of course, that this only works effectively on 3D data. So this is a cube on 3D data of one of our play types. It happens to be here, the Porquero. And on the left-hand side, you see, an elegant-looking map with a number of well locations, number of faults. It's a structural map, right? And we've called it uncalibrated 3D, but it's a very legitimate, robust structural map. It's exactly the same map on the right-hand side, but overlaid on it is the display of the seismic attribute that we call fluid factor. That allows us to simply differentiate specifically sands that are at least 30 feet thick that are charged with gas. And that creates an AVO effect that we can model and represent in a map form. And so what you see as red on that display on the right-hand side are the gas-charged sandstones within structural closure. And on this particular map sheet that I'm showing you, we're showing 1, 2, 3, 4, 5 exploration successes, drills into the AVO display there, constrained by structure. And it also shows a number of other locations that we might drill in the future. So this is what's driving our success rate, is the confidence we have in the relationship between our ability to map that attribute and the presence of gas-charged sandstones. Next slide, please. So you don't get the whole acreage map sheet here, but this is helpful. We'll just basically illustrate where we're drilling this year. We're in the southwest corner of our acreage position. The blue polygon that you see here is 3D seismic, is the extent to which we have acquired 3D seismic. And on there, what you see are a number of red features, which are our exploration discoveries that we've achieved in the last 6 or 7 years. So, so the red features are a result, if you will, of the success rate that we've enjoyed with our exploration program. The brown features are prospects that are drill ready. Okay, so on the right-hand side, what you'll see is basically a list of the wells that I hope to drill before end of year. It is abbreviated. Coming into this year, we were mindful of drilling 12 wells. Now, because of COVID, of course, and all the issues around it, since abbreviated to 9. Notice we've drilled 3. The little drilling rig signs that you see on the right-hand side show you that we have 2 rigs, both on location, one currently drilling an exploration well at Poro Norte, and one about to mobilize to Pandereta for the purpose of drilling that appraisal well. So, I'm hopeful that we can drill all 9 wells before the end of the year. We're in August, clearly feeling a little bit of pressure on being able to achieve that well count, but it's all really a function of our ability to basically manage the circumstances around COVID. But we continue to make progress in that respect. Next slide. Next slide, please. Yeah. Okay, so here we go with netbacks. So I've been talking about realized sale price of about $4.75. The numbers that you see distributed for Q1 18 to Q1 20 across the top here, it's basically a fluctuation of what our realized sales price. So on average, $4.75, as you can see how we might derive that number. And that variability is a function of the price we can achieve in the spot market, understanding that 80% of our sales is in the fixed price long-term contracts and 20% of our sales into that. So that variable realized sales price is purely a function of the price we can achieve in the spot market on any given day. And no surprise in the first couple of quarters of this year, if you look at the right-hand side of this display, you'll see that there's been a softening in our realized sales price by virtue of the fact that there's been a softening in the pricing in the spot market. Nevertheless, we are pulling off netbacks, most recently $3.63, which I think you'll all agree by comparison with the kind of netbacks that are achievable in North America are still very favorable. Another one of the variables there, of course, is OPEX, 25 cents, as displayed there in our most recent quarter there. This gas is pure methane. It's 99.5% methane. There's a little bit of water of condensation that one has to strip out in a dehy on-off. But the point being that our processing is very, very simple, very, very low cost. And there's no H2S, no CO2, no inerts, no liquids. It's just pure methane. And so that drives a very low operating expense. Royalties are shown there at 64 cents. Variable, depending. Like we produce from 3 different blocks, 3 different contracts, and the royalty varies depending on one block to another. And so depending on which one of the blocks that we are producing, tending to weight a little bit more favorably, will have an impact on what the royalty will be on any given day. Nevertheless, having said all of that, I think you'll all agree that our operating margin there, as displayed at the bottom, most recently at 80%, is a very favorable percentage. Next slide. Yeah, so here we go with our financial policy. Simply, the EBITDA that you see displayed on the left-hand side of this slide at 233 million is the EBITDA that we expect to generate at the top end of our revised guidance of 197 million cubic feet of gas per day. If we net interest, taxes, and capex off that amount, you can see the free cash flow that we might generate at that 197 million, of about $80 million in free cash flow this year. If guidance should come in at 170 million, the low end of the range, you'll see that that'll impact free cash flow such that we expect 55 million. So that's the purpose of that display, to give you some sensitivity around the impact of variable production and sales on our free cash flow. Just last week, we conference called with the investment community our second quarter results and reaffirmed our dividend of 5.2 cents, which currently is about a 6% yield on our share price. Our debt reduction is occurring by virtue of increased sales and EBITDA relative to our debt. So we are managing our consolidated leveraged ratios downward by that means. And we have a share buyback scheme underway as well. Next slide. If you're following our story, you'll be familiar that we've recently done some refinancing with our existing debt to achieve improved terms. We have also extended our debt line such that we now have additional capital available to us just to improve our liquidity as required, and have also secured our funds as a bridge term loan of 75 million that will enable us to initiate the long lead activities on the Medellin pipeline as required, and all at very favorable rates. Next slide. Yeah, so in fact, I think that's our last slide. Maybe I'll ask you to just drop back one slide. I should represent our, thank you. So there's our cash position down in the bottom left-hand corner. I didn't want to overlook that. So note that our current cash position is $59 million, and our working capital is about $72 million at this time. Yeah, thank you for that. Okay, so next slide. I think that's basically our summary slide, just emphasizing our focus on the natural gas business in Colombia. We are the largest natural gas producer in country by virtue of our fixed price long-term contracts. We have, we're confident in our predictability in terms of not just sales, but our cash flow, and that allows us to reaffirm our capex outlook along with our dividend that we are committed to, and gives us sufficient flexibility to consider buying back shares as well. So all in all, regardless of the circumstances in which we have to operate, we feel as if we're in a good place at this time. That's all I have to say. Thank you for your attention.
Mark, thank you for your presentation. Very informative, and lots of people online watching it, clearly interested in the Canacol story down there in Colombia. We only have a couple minutes before we hit the 4:30 hour, and I want to cover a couple questions that came in. The first thing is, the question is the environmental movement down there, specifically in and around the Amazon, are you feeling any kind of pressure? Is there any kind of social pushback on your activity down there related to environmental concerns?
Yeah, that's an interesting question. The short answer is no. The Amazon, of course, in country is in the southern and southeastern areas of the country. In the southeastern areas, interestingly in Colombia, there's very, very little hydrocarbon activity. It's just not prospective in that part of the country. In the southern part, along the Ecuadorian border, in the Putumayo Basin, of course, there is significant activity, and that area would be considered part of the Amazon watershed. And by all accounts, I believe that there's no big impact on the Amazon in terms of their activities, but nevertheless it's present. Our activities are situated in the northwestern corner of the country, where it's dry and absolutely no jungle whatsoever. It's a dry, arid area, and I would characterize it as being farmland, ranch land, a lot of farms and cattle, as far as the eye can see. So it's not typical sort of Amazon area, and so therefore not really in the focus. Our activities are not in the focus of those that are concerned about the welfare of the Amazon.
Yeah, thank you for that. I want to move through these last couple just real quick. There was a question about your license and the term expiration on that license for hydrocarbon. And then with that question, you mentioned your best wells were 30 to 35 BCF. What are the median or average based on third-party analysis and evaluation?
Yeah, sure. Let me ask the second question first. Good question. The average would be about 15 BCF, 15 to 18 BCF per well. In terms of the lifespan of an exploration contract, basically the answer is 6 years. So there are two phases, 3 and 3. 3 years and 3 years, during which one is committed to conduct a certain amount of exploratory activity involving seismic and drilling. Assuming success, one's success then enters into an evaluation phase where one is committed to drill appraisal wells and then provide data to the regulatory authorities so they can make their own independent assessment on the commerciality of one's exploratory discovery, at such point that they will then declare an evaluation phase, which is the appraisal phase, and then the production phase. And the economic life of a production contract for an exploratory well that is appropriately appraised is 25 years.
I certainly appreciate that and appreciate the answer. Appreciate your time coming on today. And I just want to say thank you. Thank you for supporting the Oil and Gas Conference and sharing your story with us. And I would encourage anybody that wants to get a hold of you and follow up to go ahead and look to schedule a one-on-one with you for your availability the remainder of the conference. But Mark, thank you very much. Philip, we see you there. The silent partner, good to see you as well. Have a great afternoon, guys.
Okay, thank you. Bye-bye.